Welcome back to the channel, everyone. Today I want to talk about the July failed to deliver data. Now there's a lot of weird and interesting things going on with this data, so I wanted to do a full breakdown. Trust me guys, you do not want to miss this video, so stay tuned and let's make some money. But guys, before I dive into the video, I just want to give a massive shout out to the 3,200 of you that have currently dinged that notification bell, because you guys are always the first to watch a new video as soon as it's released. So guys, be sure to drop a like down below, subscribe to the channel and ding that notification bell if you haven't already, so that you don't miss another video just like this one. And now I want to dive straight in with the key information. So, through the second half of June, we saw a very high level of failures to deliver. 4 million shares that day, 3.6 million shares on the 22nd, 3.7 million shares there, even as high as 4.4 million shares in a single day. So what happened in July? Well, in July we saw the fail to delivers start off very strong. 3.5 million, it then fell to 2.2 million, and then just completely evaporated into thin air down to 41,000, and it kind of held at that level for the rest of the first half of the month. So how did that happen? If we look back at the Threshold Securities List on the 8th of July and the 7th, 6th, 5th and so on before then, AMC was on the Threshold Securities List. But if we go back and have a look at the number of failures to deliver, on the 8th of July we saw only 9,000 failures to deliver. So how was it on the Threshold Securities List if there was only 9,000 FTDs? Because as we already know, in order to appear on a Threshold Securities List, the security must be registered with the SEC and have had 5 or more consecutive days of failed settlement. The failed settlements must also be of a size totaling 10,000 shares or more, or at least 0.5% of the security's shares outstanding, as in 0.5% of the entire float. AMC has a float of over 513 million shares, and therefore to get on that Threshold Securities List needs at least 2.5 million FTDs on a daily basis to be on the list. So how was it on the list if there was only 9,000 FTDs? Well, for that we need to dig into the technicalities of the Threshold Securities List. What the Threshold List does not reveal. The Threshold List is simply a list of the companies which, for that particular day, qualified for threshold status. The Threshold List does not. It does not reflect the short position in a particular security, but only reflects the failures to deliver for long and short positions. It does not mean that any improper short sale or long sale activity has occurred or is occurring for the securities listed. And it does not reflect only failures to deliver, because a security may remain on the threshold list longer than 13 days after broker-dealers close out all delivery failures, since the security stays on the threshold list for 5 consecutive days. If we have a look at the 1st of July, we can see that AMC had 3.5 million FTDs, and therefore it was on the Threshold Securities List. But then if we count 5 consecutive days, day 1, day 2, day 3, day 4, day 5, therefore AMC was only taken off the Threshold Securities List on July the 9th, when the failed to delivers had subsided below that 0.5% level for 5 consecutive whole days. Now you may say, hang on Tom, how on earth did the hedgies and the market makers and the clearinghouses get AMC off the Threshold Securities List? Now you may remember back to one of my previous videos where I explained the second transaction that they use to reset the clock. Assuming that XYZ is a hard to borrow security and that trader A or its broker dealer is unable or unwilling to borrow shares to make delivery on the short sale of actual shares, the short sale may result in a failed to deliver position at trader A's clearing firm. Rather than paying the borrowing fee on the shares to make delivery or unwinding the position by purchasing the shares in the market, trader A might next enter into a trade that gives the appearance of satisfying the broker-dealer's closeout requirement, but in reality allows trader A to maintain its short position without ever delivering on the short sale. Most often, this is done through the use of a buy-right trade, but may also be done as a married put and may incorporate the use of short-term flex options. Now I did explain this and draw it out at some point in one of my previous videos, but effectively this is how the market makers transfer those failed to deliver positions just to another market maker and it resets the clock. To do that, trader A may enter into a buy-right transaction, considering of selling deep in the money calls and buying shares of a stock against the call sale. By doing so, trader A appears to have purchased the shares to meet the broker-dealer's closeout obligation. However, obviously trader A has no intention of delivering those shares and is instead re-establishing or just extending a failed position. So effectively trader A buys the shares from trader B, and trader A also sells deep in the money calls to trader B. And then trader B exercises those deep in the money call options, and trader A delivers those shares back to trader B that it brought from them previously. So effectively trader A bought some shares and then gave them to trader B to satisfy the call options. Trader B sold some shares and then got them back as they exercised the call options, effectively netting out both market makers' transactions. What this does is effectively just resets the failed to deliver timeline and removes it from the Threshold Securities List, and means that trader A doesn't need to actually go into the market and buy shares to cover their failed to deliver position. However, it is important to note that trader A never obviously satisfied that failed to deliver position and effectively still has all of those failed to delivers. It also can't keep doing this forever because obviously trader B takes on some risk by selling their shares and then getting the call options and exercising the call options. Therefore, trader A has to pay quite a large premium or like a transaction fee to trader B for taking on that risk. Therefore, trader A is just effectively prolonging the inevitable, and that is the inevitable of having to buy actual shares in the actual market to cover their failed to deliver position. However, one important thing to note is there is some relationship between the failed to delivers and the AMC price. You can see here there was quite a lot of failed to delivers in a short time period, and the AMC price stayed suppressed. We then saw the number of failed to delivers trail off substantially, and we actually saw a reduction in the AMC price between the 19th of May and the 24th of May. That all then culminated in one giant day of failed to delivers as the AMC price spiked upwards. Again, here in June, we've got a very large amount of failed to delivers, with the AMC price staying suppressed. We then saw the number of failed to delivers drop off massively, and AMC has been declining ever since. It wouldn't surprise me if this is going to lead to a giant culminating day of millions and millions and millions of failed to delivers while the AMC price spikes again. Similarly to what we saw back at the start of January when we had 27 million fails to deliver in the same day. That culminating day could be caused by a certain event, such as the reverse repos being due. Any liquidity crunch increases margin requirements via NSCC's risk management algorithm. DTCC can now liquidate shorts in a day, so whether it's the delta variant that induces the risk, which increases the margin capital requirement, or AMC's rise in capital requirements due to share price increase, or just a flat out burst of the largest inflationary bubble of all time. All indicators point to a high likelihood in a breakout gain of AMC share price. Supposedly AMC is therefore the all-time greatest hedge against the crashing market. Basically, we're just waiting for that one market-wide event that happens that causes those shorts to be liquidated. Either their long positions get stressed and they have to be sold off, or their short positions again get stressed and have to be covered. This one market event is then going to cause AMC to skyrocket, because if one hedge fund topples, all of them are going to topple. Now you might say, yeah, but Tom, AMC's been falling all day. Well, don't forget that hedge funds borrowed 5.5 million shares this morning to lower the price to simulate a sell-off or market plunge. If we look at iBorrowDesk on Friday afternoon, they had 5.4 million shares to borrow that could be shorted. All of those were borrowed Monday morning and used to hammer down the price of AMC today. I also wanted to quickly go back over HR 4618. The Short Sale Transparency and Market Fairness Act. Believe it or not, there are actually 22 different representatives that voted nay to approving HR 4618. I wonder why. Every single one of the politicians who voted against the Short Sale Transparency and Market Fairness Act has received campaign contributions from some combination of hedge funds, big banks, family offices, another type of fund, or other investment groups that benefits from the current market structure. Blackstone Group has their name over all of these politicians. BK2 Holdings is a weird shell dark money company linked to a billionaire hedge fund manager and has had their hand in a lot of these pools. UBS and Bank of America are also other very common names on these lists. Wells Fargo to a slightly lesser extent as well. And believe it or not, the DTCC and other clearing houses are also on some of these lists. Yes, the DTCC are also donating to those politicians. Remember, this is only the reps on the Financial Services Committee who voted against this bill. The bill will at some point go to the House floor for a full vote. Call, email, tweet at, do everything you can to contact your reps that may be on this list and request an answer as to why they voted against a bill that goes against the best interests of their constituents. Demand answers. Birdbear actually managed to put together a list of all institutions that donated to those politicians' parties. If I just slowly scroll through this list, you can see which institutions are the major players in sponsoring these politicians and their parties. I'll also put the link in the description of this video so that you can have a look for yourselves. Believe it or not, there are also 3 politicians that had received donations from none other than Ken Griffin and Steve Cohen as well. Guys, be sure to let me know down in the comments below what you think of the July failed to deliver data and also about the politicians that were opposing HR 4618. And guys, if you haven't already, I'd really consider joining the Patreon and the private Discord and becoming part of the team. That way you can get urgent updates and news and due diligence on AMC before I even make a video, linked in the description below. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers!